Good morning, everyone. My name is Francesco Billeri. I'm director of Bocconi. I'd like to welcome all of you, students, faculty, staff, and friends of Bocconi to today's event. We are very glad to have you on our campus. The event is on monetary policy and financial stability, so very hot topic these days. And it's organized jointly by our Buffy Center on Economic, Finance and Regulation and Institute for European Policies at Policy Making at Bocconi University. In collaboration, and this is also a very nice feature, with our Bocconi Student Finance Association. So we are extremely honored to have Professor Isabel Schnabel, in addition to being a colleague in academia. She's, as you certainly know, a member of the executive board of the European Central Bank, and she's on leave from her chair at Bonn University. After the lecture, our colleague, Professor Carlo Favero, will be a discussant, and the Q&A session will be led by the Bocconi Student Finance Association. So, again, a nice combination and synergy between the different components of the Bocconi community. I also like to thank very much the chair and the great motor of this event, Professor Enela Carletti, who's a professor of finance, but also the dean for research of Bocconi. And among the other thanks, Professors Donato Masciandaro and Daniel Gross of the two centers, and Theodore Yalmatei of the Student Association will moderate the Q&A. And also, to be frank, these events need careful organization and planning, so this is also a public important event. So I'd like to thank Elena Suragni and Silvia Tesauro from the Buffy Center and IEP. So without further ado, I'd like to open officially this event by giving the floor to Professor Carletti. Thank you very much for being here, and I look forward to hearing all the works of this event. Thank you very much.
Good morning to everybody, also from my side, and welcome to the event entitled Monetary Policy and Financial Stability with Professor Isabel Schnabel. As the rector already said, my name is Elena Carletti. I'm professor of finance and dean for research here at the university at the moment. I am particularly happy to have managed to have Isabel here today with us, not only for the important topic that she's going to cover, and the title of the lecture is going to be, Has the Fight Against Inflation Been Won? But also because actually Isabel and I have been friends for a very long time. We were colleagues in Mannheim back in the early 2000s, and therefore it's particularly nice for me today to meet her in her capacity as executive board member of the ECB and to see her again today in Bocconi. So the title of the lecture well summarizes the current debate about monetary policy and the future path of interest rates. We are, as we all know, in a situation where in the last 18 months, the ECB has increased rates significantly. And now we are all very eager to know, is this the end? Are we going to see a cut decrease soon in the next month, in March, in April, in June, wherever, in which meeting are we going to see it? Or rather, we are going to see instead a stable path of interest rate. That means a high for long scenario. And I do remember a few years back, before Isabel joined the ECB, we were both at the European Systemic Risk Board, if you remember, and we both worked on a very nice report that was entitled The Low Interest Rate Environment. And I remember that we were looking at two scenarios. but none of us was actually looking or thinking of a scenario where rates could have gone up so rapidly in a very short period of time, except Isabel, that I remember was pushing already at that time to consider that scenario. Do you remember that? But then that scenario was not included in the final version of the report, and now see where you are and what happened, and somehow she could see that forthcoming in some way. So let me also thank the centers that have contributed to organize this event, the Buffy Center on Economic, Finance and Regulation, and the YEP at the Bocconi University. So the two directors, Daniel Gross and Donato Masciandaro, and also Sibi Goulart. I don't know if she's here, but she's the vice president of the YEP. She should be joining us in a minute. And also the president of the Student Association, Leon Reidel, and the student that will moderate the questions, that is Theodore Johan, I just missed the name, but anyway. Okay, I will mention it later, but Theodore, because I always call him Theodore, so Jon Mattei, sorry, now it came to my mind. And we have been collaborating and writing for very long over this month to organize this event. Organizational-wise, we have 30, 40 minutes Isabel's speech, then we have Carlo Favero for 10, 15 minutes, then 15 minutes for the Student Association, and then we can see whether we still have a few minutes for general questions. Before giving the chair to Isabel, as the rector already said, Isabel is a professor of financial economics at Bonn University on leave. Before that, she completed her PhD in Mannheim with the chair of Professor Martin Hellwig. This is where we initially met. Then he was a senior research fellow at the Max Planck in Bonn. Then she went to University of Mainz, first as associate and then as a full professor. Then she became a member of she became professor in Bonn in 2015. But in addition to that, if academics want to be influential or take policy position, normally they also have to do some policy work before. So in addition to the university position, she occupied several policy positions. She was a member of the German Council of Economic Experts for 5 years. And then she was a member, actually the chair at some point, of the Advisory Scientific Committee in the European Systemic Risk Board. So given that, let me give the floor to Isabel. Let me thank her again for being with us today, and the floor is yours.
Oh, thank you. Do I have to turn those off? Buongiorno. Thank you so much for having me. Thank you for the kind introduction, Mr. Villari and dear Elena. It's a great pleasure and honor to be here at Bocconi University, which is, of course, as you know better than I, one of the very best business schools worldwide. So congratulations to that. It's really fantastic to be here. And it's also good to be able to talk about my favorite topic, and of course a topic that is on the mind of central bankers all the time, which is the fight against inflation. And so today I would like to guide you a bit through our thinking and my thinking at the ECB about what has happened in the past and what is happening at the moment. And of course, I cannot tell you whether it's going to be March, April, June, or whenever, but I can tell you a bit about our thinking. And actually, I would like to start by going a bit back in time. And I think it's good to have another look at the causes of this quite dramatic surge in inflation that we've seen. And so this chart gives you an overview of what has happened since the beginning of the pandemic. And so if we start with the left-hand side chart, which is showing the development of real GDP, I would like to point you towards two important observations. So the first is you can see that there was this
dramatic contraction in economic activity at the start of the pandemic. And then there was this pretty sharp recovery, what some people call the V-shaped recovery, which was then interrupted by various waves of the coronavirus. But then the second striking observation is that actually the second big shock that we've been facing, the Russian invasion of Ukraine, is hardly visible in that chart. So the only thing you see is that towards the end, growth has been slowing a bit, but there is no comparable contraction to what we've seen in the pandemic. So what did all of that mean for inflation? And for that, you should look at the right-hand side chart. And there you can see that actually in the first year of the pandemic, inflation went down. And it even moved into negative territory. So at the end of 2020, inflation was in negative territory. And then this really dramatic surge in inflation started from negative levels to a peak of 10.6% in October 2022 in the euro area. So what were the reasons for this sharp rise in inflation? And I mean, there were two main reasons for that. So the first is that there was an imbalance of supply and demand. So after the lockdowns, the economy reopened, and we had this surge in demand, but at the same time, supply was still being constrained by various supply chain disruptions. And this imbalance of supply and demand was one of the reasons for this sharp rise in inflation. Then, of course, this was reinforced by the sharp increase in energy prices, which was also related to the Russian war in Ukraine. And but then you also see that since October 2022, inflation has come down quite a bit, from 10.6% to now 2.8% in January. And I'm going to say a bit more about that over the course of my talk. So the ECB responded quite strongly to this surge in inflation, and you can see this on this slide. On the left-hand side, you see our key policy rates, our main rate being the DFR, the deposit facility rate, which we increased from a level of minus 0.5% to a level of 4%. And so the hiking cycle started in July 2022, and the last hike took place in September 2023, and since then we have kept our policy rates constant. On the right-hand side, you can see that we also started to normalize our balance sheet, and as you can see quite impressively on that chart is how big the expansion of the balance sheet has been over the past years. And that started, of course, with the QE program, as you can see very nicely. But then we had another big push in the course of the pandemic. But you also see that the balance sheet now has come down quite a bit. So what happened? So the first thing we did is that we stopped our net asset purchases. And you can see that with these the purchase programs kind of flattening out. We also started our gradual QT, quantitative tightening, which means that now some of our programs are already starting to come down. But if you look at what has really been responsible for the decline in the balance sheet, it's really the repayment of the longer-term refinancing operations, which you can see there in yellow. So looking again at inflation. So what this chart shows you is the typical decomposition of inflation into its four main categories: energy, food, non-energy industrial goods, and services. And what you can see is that the sharp decline in the HICP, so headline inflation, was mainly driven by a reversal of the previous supply-side shocks. So you can see that the contribution from energy, shown in blue, came down and actually has been negative over the past couple of months. Food inflation also has come down. Core inflation, which is the sum of the yellow and the red part, has proven a bit more stable, more sticky. And in particularly, this is true for services inflation, which has actually proven quite sticky. And again, I will say more about that in the course of my talk. But let's first have a look at what I mentioned before, the reversal of supply-side shocks. So here on the left-hand chart, you see the evolution of energy prices, which was quite dramatic. So you can see these spikes in both oil and gas prices, with the increase in gas prices being the most extreme. But you also see that energy prices have normalized quite a bit. They still remain above the pre-pandemic levels, but the decline has been very strong. On the right-hand side, you see one of the indicators for supply chain disruptions, which is shipping prices. And there you can see shipping prices from China to the US and from China to Europe. And you can nicely see how these shot up during the pandemic, how they have really normalized then relatively quickly. And you can also see at the very end that there has been another pickup, which is related to the Red Sea distortions. But you can also see, so first of all, you see that Europe was affected a bit more by that. But you can also see that compared to what we've had in the pandemic, this is relatively small. So this chart now goes a bit into the details of the composition of inflation. And we are looking here at core inflation, the two components of core inflation, which is goods inflation and services inflation. And what this chart is showing you is the parts of the respective basket that is at different inflation rates. So for example, the dark blue part are those parts of the consumption basket that are at inflation rates below our target of 2%. And you can see how the composition of the inflation rates in the basket changed, I mean, really dramatically over the past years. And if you look at the left-hand side, on the good side, you see that first you had this kind of massive broadening of inflationary pressures, but then you also see that you had a rather quick reversal. So the inflationary pressures are actually fading. And for the goods, that's actually related to the fading of the supply chain disruptions. On the right-hand side, you can see services. And also there, we have seen a certain reversal. But again, you can see very clearly that services inflation is much more sticky. And even now, something around 90% of goods in the services basket still have inflation rates above 2%. So my next slide shows you our staff projections, the most recent staff projections, which are from December of last year. And what you can see there nicely is that, so you've had this sharp decline of inflation. On the left-hand side, you have headline inflation. On the right-hand side, you have core inflation. But you also see that according to our projections, this disinflationary process is expected to slow. So you see the curve is really flattening quite a bit. And this is, of course, related to a debate that you're probably aware of, which is this debate about the famous last mile. So the question whether the last mile of disinflation may be more difficult than the start of the disinflationary process. And so I've given speeches on that topic saying that this could in fact be true, so that the disinflation that we've seen at the beginning was a bit like, these were kind of the quick wins of disinflation, the reversal of the supply side shocks. But now it's really about countering what is called the second round effect, which is a bit tougher, which is more closely related to monetary policy itself. And if you want, this flattening of the path in the projections is consistent with this idea of the last mile of disinflation being more difficult. Of course, we're looking very carefully of how our sharp interest rate hikes are transmitted to the financial sector and to the real economy. And on this slide, you see that the transmission to financial conditions was quite strong. So on the left-hand side, you see the cost of borrowing for firms and households, and it's quite impressive how these have gone up strongly over the past years. On the right-hand side, you see that this also had an impact on bank lending. So bank lending flows basically came to a standstill. And what we know from our bank lending survey is that this is to a significant extent driven by a decline in loan demand. And so here we see that our transmission is clearly working. One of the sectors that is most sensitive to interest rates is housing, construction. We've seen that construction activity has slowed quite a bit. And we are also seeing that there has been a certain cooling of real estate markets. But we also see that there's a lot of heterogeneity. So on the left-hand side, you see house prices. On the right-hand side, you see commercial real estate prices. On house prices, you see there is a wide variety across different Euro area countries. And maybe the first striking fact is that actually over the pandemic, house prices were going up quite a bit in some countries like the Netherlands and Germany. These are also the countries where you've seen the largest decline in house prices, but it's actually quite striking that house prices still stand well above where they were before the pandemic. I mean, Italy seems to be a bit of an outlier in the sense that house price developments were actually pretty flat over the entire period. And actually that's also true for the commercial real estate, where there has not much happened in Italy, whereas in Germany you see quite a decline. Both in the area of retail, which may partly be related to people doing more online shopping and less going to the city center to buy their things. But we also see it in offices, which again is probably also related to structural changes related to working from home. But I mean, maybe you could say that given the sharp rise in interest rate that we've had, these markets still look relatively resilient. One could have expected a stronger decline. But of course, there are other factors affecting real estate prices. So then the question is, what is happening to the real economy? And just to remind you, monetary policy is, of course, working by affecting the growth in aggregate demand. And what I show on this slide is again core inflation, the two components, goods on the left-hand side and services on the right-hand side. And there is this debate about inflation having been transitory in the end. So people who are in favor of that hypothesis say that, well, even if the central bank had not done anything, inflation would have come down nevertheless. So if you, and the reason, the story behind that is that the buildup of inflation was mainly driven by supply-side shocks, and these shocks have now reversed. And it's in fact true that part of the decline in inflation that we've seen is due to supply-side factors. So these are the green bars in this chart, and you see the green bars actually matter for both goods and services inflation, and that has come down. But we also see, at least on the left-hand side, that the demand component has also come down. And this is something that is, of course, coming from monetary policy. The interesting thing is that if you look at the right-hand side, that actually the blue bars, so the demand factors, have been much more constant. So it seems that that monetary policy had a somewhat weaker impact on services than, for example, on goods. And maybe this is also quite plausible if you think about it. I mean, the services tend to be much less capital intensive than goods production. And so it's maybe natural that interest rates have a lower impact on services inflation. So we see that the transmission to services has been somewhat weaker. So I mentioned already that housing was pretty strongly affected by higher interest rates, and this is also confirmed by the data on investment. So you see on the left-hand side the blue bars. So this is housing investment, and you've seen a decline actually very early on, already in the second quarter of 2022. So even before the rate hikes actually started. But business investment did not respond to the same degree, which may be surprising. I mean, one factor seems to be that there were actually still order books that were quite full, which explains that business investment only reacted with a lag. But there could also be a different reason. And this is related to the right-hand side slide. So that the right-hand side slide shows you what has happened to industrial production over the past years. And what you can see is that starting with the Russian invasion of Ukraine, we have seen this stark divergence of the evolution of high energy intensive and low energy intensive industries. And the collapse in the high energy intensive industries has been particularly strong, which is not surprising given the sharp rise in energy prices. But the point is that this is probably less of a cyclical phenomenon, but it's much more of a structural phenomenon. And the question then, of course, is what is the response to such structural shocks? And you could say that there's now an even higher urgency, for example, to push forward the green transition, which would then, in spite of higher interest rates, still actually lead to higher investment just because it's necessary in order to manage this transition. It could, of course, also be, and we've seen some numbers on that, for example, from Germany, that some companies simply decide, okay, Europe is too expensive, and we just move to other countries like the US. That's, of course, the worst outcome from a European perspective. One factor that has weakened monetary policy transmission is the very resilient labor market. And this has actually been a surprise to many analysts, how resilient the labor market has been. And this is shown on the left-hand side chart, where you can see in the yellow curve that employment has been growing strongly. And at the same time that the blue curve, the unemployment rate has fallen to a historical low. The right-hand side chart shows survey evidence on labor scarcity, and you can see that labor scarcity has gone up a lot and actually remains pretty high, especially in services. If there's a lot of labor scarcity, it may not be surprising that there's also strong wage growth. And of course, we have to remember that especially at the beginning when inflation was going up, wages did not grow to the same extent. So many people experienced a dramatic decline in their real wages, and there's now the wish to recover some of these real wage losses incurred over the past years. And so it's not surprising that wage growth has been pretty strong, also because given the labor scarcity, the negotiation power of the workers has increased, and all of this has then put upward pressure on wages. So we do see that there's a bit of a flattening out and potentially also a little bit of a reversal, which then still needs to be seen. The right-hand side chart points to another very important development, which is that we've seen a decline in labor productivity over the last years. And there are several reasons for that. I mean, one reason is that many firms have resorted to labor hoarding, which means that even though the economy was relatively weak, they did not lay off workers because they were afraid that once the economy would pick up, they would not be able to rehire these workers again. And this is one of the factors that is said to have driven labor productivity growth, which has actually been negative now over several quarters. And taken together, the strong growth in wages and the decline in productivity has led to historically high growth in unit labor costs. And this is what matters for the companies, and then also for the price setting of companies. And this is what I'm looking at my next slide. So this is a decomposition of the GDP deflator, which is often used as an indicator of domestic inflation. And what you can see here is that if you look at the green bars, this is a contribution of the unit labor costs. And you can see that they contributed quite a bit to the rise in the domestic inflation that we've seen over the past years, and actually the contribution remains very strong. You also see that the red bars, which are the unit profits, contributed quite a bit. And what we've seen is that in quite a few sectors, firms not only passed through their higher input costs, but they were actually even able to increase their profit margins. And so they increased prices even more than their own costs had gone up. So in order to contain this process, monetary policy then comes in, and as I said, monetary policy works by dampening aggregate demand. And this dampening of aggregate demand implies that it's much harder for the firms to actually pass through their higher input costs. And so the evidence that we're seeing is that firms are starting to absorb the higher costs in their profit margins, which then means that the inflationary pressure goes down. Of course, we are watching this very carefully. We are assuming in our projections that the profit margins are going to absorb a large part of the rise in the unit labor costs, but this, of course, still remains to be seen, and especially if the economy were now to pick up over this year, the question is whether the firms would again be able to pass through a higher share of their rising costs. Let me mention one other very important channel of monetary policy transmission, which plays a highly relevant role in all the models, which is inflation expectations. And that was always of great concern to us, that we wanted to make sure that inflation expectations remain firmly anchored. And I mean, there was a time when we saw that some of the indicators pointing to risks of a de-anchoring were actually moving up. And I think one of the big successes of monetary policy over the past years has been that we managed to anchor inflation expectations pretty well around the 2%. So here I show two measures of inflation expectations. There are many others. On the left-hand side, you see survey data from professional forecasters. And there you see, I mean, that looks nicely how you want it to look. It's centered around our target. And actually you can see, so the most recent curve is the dark blue one, you can see that it's now anchored actually more around the 2%. And also this little right-hand tail that you still see in the red curve, that has actually come down, which gives us some confidence that the risk of de-anchoring has come down. The right-hand side chart shows you the results from our consumer expectations survey. And you know, we always tend to say that they are also well anchored. But if you look at the chart, actually, I mean, to be honest, consumer expectations are all over the place, right? I mean, you have many people just expecting 0. You have people expecting something around 2. Then you have some people expecting something around 10. I mean, it's maybe a bit going too far to say that inflation expectations are firmly anchored around 2. But what we can say is that we were able to avoid, big shifts in this chart. And actually also, if you look at the median, this is actually, it's pretty close to 2%. But we see that consumer expectations are actually quite a tricky thing. But the remarkable thing is that, you have to remember what we've been going through. This was the largest inflationary shock that we've ever seen in the euro area, and still we managed to keep inflation expectations anchored. So that is a big success, and we shouldn't forget about that. And I would argue that if we hadn't responded to this surge in inflation, it's very unlikely that the picture would look the same way as it does here. So I mentioned before that we stopped our rate hiking cycle in October. So October was the first meeting when we announced that we were pausing the rate hiking cycle, and you can see that in the yellow curve. And what I'm also showing here is another curve, the blue curve, which is a measure of financial conditions. And what is actually quite interesting is that even though the policy rates remained constant, the financial conditions, the blue curve, have actually come down quite a bit in anticipation of future central bank action. So as soon as the central bank said we are not hiking this time, markets started to quite aggressively price in the central bank pivot. And this is reflected in this blue curve, which has already come down quite a bit. And, if you look around, you also see that this is already reflected in some of the relevant interest rates. So both lending rates and deposit rates have tended to come down already, even though we have not yet started to cut rates. And if you go back a bit in the chart, you can see that that was also the case with the tightening. So you see that the blue curve also started to go up earlier than our policy rate. So market expectations, of course, matter greatly. And so it's very important to understand that even though we have been keeping rates constant for quite a while, actually financial conditions have already loosened. So if we look at the most recent evidence on the economy, we are seeing first signs that the economy is bottoming out and gradually recovering. So with a strong wage growth and inflation coming down, real incomes are going up, which is expected to also lead to higher consumption growth. And on the left-hand side, you can see, these are the PMIs, the Purchase Managers Indices, which are used very intensively by all analysts, including central banks. You can see that they have, except for construction, which is in deep contractionary territory, they have actually turned the corner. Manufacturing is still in contractionary territory, but services have actually reached again a neutral level, which is the most recent data point that just came out this week. The second panel gives you the Citigroup Economic Surprise Index, and also there you see that after a long time of negative surprises on the economy, actually more recently, the surprises have mainly been on the positive side. So there is some reason to believe that the economy may pick up. On the right-hand side, you see one other reason why the economy may actually be picking up, which is that our models tend to suggest that the peak of the impact of the monetary policy tightening may now be behind us. So that the impact of the tightening is actually going to fade, which then again is going to support the recovery. So maybe let me then say that, of course, the central banker's dream is that we win the fight against inflation without causing a recession. So that is the famous soft landing. And I mean, there is hope that we may be able to achieve that. And this is, of course, what we are working on. I mean, I've always argued that we have to be a bit careful not to loosen financial conditions too early, that we need to be a bit patient, that we need to be cautious, that there are reasons for the last mile to actually be more difficult than the first phase. And I mean, I've showed you a lot of evidence on that, on services inflation, the resilient labor market, and also the loosening of the financial conditions that we've seen already. And I mean, the time will come when we are confident enough that inflation is going to sustainably return to our inflation target, and that is then going to be the beginning of the rate cutting cycle. So, Elena, if I may, can I still go say a few words about Italy? Do I have the time? Okay, because I thought, given that we're in Italy, I only talk about the euro area, but given that I'm in Italy, I thought it's maybe interesting to point out just a few things about the Italian economy. So here you see again real GDP and inflation, and what you can see is that actually the contraction in Italy was particularly strong. In the pandemic, the recovery was a bit slower. But then if you look at the very end, you see that Italy has actually developed slightly better than the euro area as a whole. On inflation, you see that the peak of inflation in Italy was somewhat higher. But now we've seen also that the disinflationary process has been quicker, and inflation in Italy now actually stands well below 2% and is expected to stay there for a while. One issue that, of course, is very relevant for the Italian situation is sovereign bond markets. And so on the left-hand side, you see the sovereign spreads of various euro area countries relative to a risk-free rate. And I mean, if you just look at the very left panel, I mean, you probably all remember the dramatic spikes that we have seen in those spreads in the euro area crisis. And if you just then look at this little window, you see that now the spreads compared to that, they are very, very low, right? In spite of a bit of a movement that you can see in this expanded window. And especially Italian spreads, they have been quite contained. And this is something which is remarkable, because remember again, we've had the steepest rate hiking cycle in the history of the euro area, and nevertheless, the Italian spreads remained contained. And I mean, this is of course partly related to policies, national policies in Italy. It's of course also related to what the ECB did, and in particular, the new program that we introduced in 2022, the Transmission Protection Instrument. On the right-hand side, you see that, nevertheless, the high government debt ratio in Italy remains a concern. So this debt ratio is much higher than in the euro area as a whole. And so there are some fiscal vulnerabilities. We know very well that the solution to that is not only consolidation. I mean, it probably won't work without consolidation. But another very important factor is, of course, economic growth. And that already leads me then to my next slide. And this is taken from a speech that I gave last week at the European University Institute in Florence on the topic of productivity in the euro area and how we can deal with this competitiveness crisis that we are seeing currently in Europe. And there, I mean, I showed, and this is the left-hand side chart, I showed the developments of, the long-term developments of productivity. And what you can see there nicely is how in the, I mean, here I show the US and 4 euro area, the big euro area countries, you can see how a productivity growth, a productivity picked up nicely over several decades. And then sometime in the 1990s, there was actually this divergence. And you see Italy, which is shown in the green curve, it is actually, productivity has basically not grown since then. We also know that the overall growth performance has not been very good. And of course, that seems to be one of the key factors for Italy, how to bring Italy back to long-term growth. And one of the reasons for this that I mentioned in my speech last week is firm size. And Italy is one of the countries where the companies tend to be very small. So as you can see on the right-hand side, 70% of the firms in Italy have less than, it's wrong, sorry. 70% of employees work in firms with less than 50 employees. So companies tend to be very small. The number in the US is 25%, so 70% in Italy, 25% in the US. That is something that one at least needs to look at, because the small firm size may hamper technology diffusion and productivity growth, and that's one of the issues to look at. So interestingly, if you look at investment developments over the past years, and this is my final slide, you can see that Italy performed very well. So both public and private investment have been stronger than elsewhere. Of course, the super bonus scheme played a very important role for housing investment. And then in addition, there was the Next Generation EU, which, of course, to a very large extent is to be used for investment. And I always say that Next Generation EU is a project that must not fail. So this was a huge step that many would have thought of as being unthinkable just a couple of years ago. It's a huge step, and it has to succeed. That is very important. We're of course seeing there are some difficulties. So all the countries are facing certain delays in spending the money. Maybe it was also too ambitious to spend such huge amount of money in such a short period of time. But overall, it's going to be very important that the evaluation of this program is going to be positive. And for that, of course, the relevant governments have to put all their efforts into not only spending that money, but spending that money in a way that is most efficient. And I think at this point, I would like to stop. Thank you so much for your attention. It's a great pleasure to be here.
Thank you very much. Thank you, Isabel, for this very exhaustive speech. So I'm sure that we will debate many of the aspects that you mentioned. But first, let me give the floor to Carlo Favero, Deutsche Bank Chair in Quantitative Finance and Asset Pricing here in Bocconi University, but also a deep knowledge of monetary policy for many years. So please, Carlo.
Thank you very much. It's a great pleasure to be here, of course. And the speech was very rich and very nice. I have 10 minutes, so let me just start that I will focus on one aspect, which is uncertainty. And I think Elena was very well aware of the pervasiveness of uncertainty. In fact, when she announced the time allocated to each speaker, she gave a confidence interval, not a point time, right? So what are the relevant elements to think about where are the interest rates going? So I start with a picture which takes a little bit of longer term view from the 80s to now. Of course, blue lines are for Europe and they start with the beginning of the euro area. Red line are for the US. And what I plot in this graph are the monetary policy rate, which are the two solid lines. Red is the Fed fund, and the blue is the euro short-term rate that at the beginning of the sample is the EONIA rate. And then I have the long-run inflation expectations. And I think that from this graph, you take home several points that are relevant to understand uncertainty. First, there is a trend. And this trend is stochastic. That means that it's not a trend that you can easily predict, to be simple. But the trend, it's mainly a trend in the real rates, not a trend in inflation. This is, I think, an important feature because the central bank cannot control the real rate, but it has to get the equilibrium real rate right. And that is a constraint under which monetary policy works. And it's a constraint which is not easily satisfied because the real rate is not observable and it's surrounded by sizable uncertainty. So stable inflation, these are inflation expectations, and Isabel did a fantastic job in illustrating how anchored they were, these inflation expectations, even over the last cycle. So the point is trend in real rate, but there is also another aspect of this picture that I think is very eye-catching, which is there is a clear leading signal for the blue line if you look at the red line, okay? So if you look at this data, you do eyeballing econometrics, it's obvious that the Fed leads the ECB, or if you want to put it the other way, the ECB follows the Fed. Okay. Let me just elaborate a little bit on this. And this other graph, it's just to tell you how anchored inflation was and how little movement there is in long-term inflation expectations. Of course, if you look at the euro area, it's spectacular. The long-term inflation expectations were always very close to 2%. If you look at the US, there was a little bit of convergence to the Fed target that was low in the 80s, but then from the new millennium onwards, great stability also here. Okay, let me skip this. So, uncertainty on the natural rate. Okay, the natural rate is the equilibrium real rate. It's something that central banks cannot affect, but it's something that acts as a constraint on monetary policy, in the sense that, of course, the central bank controls the nominal rate, but if you use the nominal rate without getting the real rate right, you might be pushing the economy in the wrong direction. And the wrong direction here means that the risk is mostly for growth, not for inflation, because we have seen from the previous picture that inflation has remained anchored. Now, of course, natural rate depends on real forces in the economy. And our rector is the first to teach us that the main structural driving force in the economy is the demographic structure of the population. There is also, of course, productivity, but these are not under the control of monetary policy. So, what is the real rate? Is the rate that prevails when economy is in equilibrium. And in the standard Ramsey model, it depends only on productivity. But if you try to fit a model on the data in which you have only productivity driving the real rate, you never get it, because there is a shift in preferences. And the shift in preferences is, you need long data to get it. But if you do it for the US, where you have long data, the demographic structure of the population does a fantastic job in predicting it. Now, the problem with Europe is that it's very hard to measure the real rate in Europe. Why? Because in the euro area, we have only 20 years of data. And if you want to look at the effect of forces like demographics on financial variables, you need much more than 20 years of data. So, of course, ECB is well ahead and is doing research. And so in one of the last bulletins, there was this very interesting picture which gives you an idea of the thought that the ECB is being given to the real natural rates. And so there are different, I'm not going into detail of this, but what you get from this picture is that, wow, there is a huge uncertainty because there are different measures that are, all of them are serious, well-constructed measure, but if you look at the range, it goes from, it's 250 basis points, right, which is a kind of uncertainty that if you are worried about where monetary policy is going, it's truly sizable. Okay, let me just give you an idea of how you can use this stuff for the US, right? And here it's a very simple model in which you try to get the real rate from the demographic structure of the population, the middle age to young, the productivity, which is taken, measured by the potential output growth, and then you have to move from the real rate to the nominal, you add long-term inflation expectation. And then you have a cyclical model of monetary policy in which you say, well, the Fed is controlling the cycle, and the cycle, which are deviation from this long-term trend, depend on the two standard variables, the output gap and the inflation gap. Now, what I want to show you is that how well the long-term factor predict the trend in rates. And second, I want to show you what happens if you try to use this model before the COVID risk, before the COVID shock, to predict what happened in US monetary policy, but conditional upon the evolution of the output gap and the inflation gap. This is the trend, okay? And you can see that the demographic and productivity could have predicted the decline in long real rate, and going forward, they tell you that the equilibrium real rate for the US is going to be very stable around 2%. And this is what happens when you use the model. Again, uncertainty, so you have confidence interval. The solid line, it's what the Fed has done, and the dotted blue line is what the model would have predicted with confidence interval. So from the point of view of the model, you can see that what happens is that the Fed was a bit late, then made up, and now rates are really at model consistent level, okay? So here is my last slide, risk and difficulties, right? So I'm very sympathetic with the ECB, and because I'm aware of how difficult is their job, but I think that the main difficulty is to get the real rate right. The problem, so what are the risks? I don't think that inflation is the big risk now. I think the big risk might be growth, and then with growth, you tend to take into the picture fiscal policy and potential instability related to the sources that Isabel has pointed out in their last set of slides about Europe before going to Italy, i.e. public debt. I think that, you know, especially these days, news and market tend to concentrate on one issue at the time. So the big issue so far has been inflation. I think inflation will go out of the focus. And then the interesting question one should ask is, what's next? And it might be that fiscal instability could come back. And then we're going to see if the recent stability of the spread it's something that it's here to stay or not. Last thing I like to state is that fiscal policy played an important role in inflation stabilization in Europe. And again, let me quote the ECB in the last bulletin. There is a very interesting work on showing how there were cross-sectional impact by age and income of the last inflationary shock, and fiscal policy had a huge, significant effect in smoothing that asymmetries. So, of course, we must be very aware that the situation in Europe has been very different from the situation in the US, right? The last inflationary bout in the US was mainly demand-driven. In Europe, there was this mixture, to say the least, of demand and supply, and the fiscal policy replied correctly to the supply side and played a big role in bringing this inflation shock under control. But of course, now if you believe the usual Taylor rule story, the task of the Fed was easier because you had the output gap and the inflation gap going in the same direction. So it was classical demand shock, easy to counteract that with monetary policy. For the ECB, it was much more difficult, right? Because you had the output gap and the inflation gap going opposite direction because there was the supply side. Now, within this framework, I think one should be concerned about not missing the equilibrium real rate. Soft landing is very important. And within this frame, then last word on the past data, think about my first graph. If you look at the first graph, the timing of the ECB, it's the timing of the ECB cut. You look at the data, it's very hard to tell, but one thing is for sure, wait for the Fed to make the first move. That could be dangerous.
Thank you, Carlos. So he has brought in a new topic in a way to the speech of Isabella. First of all, this equilibrium real rate, how important it is, how difficult it is to know what is in Europe and how difficult for the ECB to target it. And then also not inflation, but growth as a next focus to think about. Before giving the floor to the Q&A, let me give the floor to Isabel to just respond on these points, and then we go to the Q&A part.
Yeah, so thank you so much for these excellent remarks, which I think were a very nice complement to what I've shown here. And as you know, we are very intensively thinking about our star. And, conceptually, this is, of course, the concept to look at. But as you also mentioned, the estimation, in particular, the estimation in real time is very challenging. And so, given these huge confidence bands that you also mentioned, it's very hard to operationalize. And there actually, I would say there are kind of two types of debates. One is the debate. So, where is our star going to end up over the longer run? And there are different views on that. And to be fair, it's all speculation. I personally think it could be, and we've actually seen that in the past, that big shocks lead to a reversal of the long-run trends. And so I wouldn't be surprised if over the long run our star was actually going to move up, with the main argument being that the world as a whole, so we could even think about a global R star, the world as a whole is going to have an enormous demand for additional investment in order to manage the big transitions. In particular, of course, the green transition. And I always say this is not, this investment is not even a choice, because either you manage the green transition with a lot of investment, that's the better choice. If you don't do that, and maybe in any case, you will face extreme weather events, which are very costly and require a lot of investment. And then the climate is going to change, and you have to invest in order to adapt to the new climate. So So the world may actually look different from what it looked like over the past decades, where we had a situation that we had this kind of global savings glut on the one hand, and relatively little investment. So it may actually change in the two ways. So the global savings may actually come down, and the investment may actually move up, which would then speak in favor of our star turning the corner. But as I said, that's all speculation, and it's irrelevant a bit for our day-to-day monetary policy. What we would like to know is what is the short-run neutral rate. So in order to have an idea of how restrictive our monetary policy actually is, and you know, the problem is we don't know where the short-run R star is. We have a bit of an idea, but we don't know precisely. I mean, some people say it has gone up. Some people say maybe not. And so that means that we somehow have to deal with this uncertainty that you rightly stressed. And what that means is, of course, we will continue to look at all the data we get in order to understand how restrictive our policies are. What complicates our situation even more is that, of course, all our policy measures are also working with a lag. And so we have to deal with all of that. Maybe just one final remark on your point on the Fed. So so first, let me say that, of course, the global financial system is closely interconnected, and whatever happens in the U.S. always has an immediate impact on our financial markets. And so in this way, it already directly feeds into our analysis and so on. Nevertheless, of course, our policy rule does not say anything about the Fed doing this or that, but we're looking, of course, at the euro area situation. And so I can assure you that if the economic situation in the euro area is different and requires us to act first, of course, then we are going to do that. And so there's no logic that we have that we need to follow the Fed, even though your graph was actually quite nice. So maybe I stop here. Thank you very much.
Thank you, Isabel. So let's just now go to the Q&A session led by the Bocconi Student Finance Society, and in particular by Theodor Jan Matej.
Thank you very much. Firstly, allow me to once again thank you all for being here, and I want to extend a special thank you to my colleagues at the Finance Society who were an important part of this event. So I would kindly invite you to thank you with a warm round of applause. And let me also just say that when we had the initial idea for this event, and I sent an email to across Bocconi to try to see how we can partner with the university, Dean Carletti replied in literally 30 minutes, the fastest reply I've ever gotten, and the support we had was overwhelming. So thank you very much again for that. And of course, thank you, Professor Schnabel, for being here. Let's go back to the overarching theme of the event, which we named Monetary Policy and Financial Stability. So normally and conventionally, we have one tool for one policy goal, the famous Tinbergen rule. But obviously, central banks are responsible for both monetary policy and macroprudential policy. So I'm wondering, how do you think about the interactions between these two policies, and can we or should we use monetary policy for systemic risk management purposes?
Okay, thank you. Very, very interesting question. And first of all, let me thank you for having been part of the organization of this event. I mean, for me, it's actually quite nice that the students are directly involved. I'm very happy about that. So on your question, so first of all, of course, Europe is always a bit more complicated. So it's not that easy. What you're describing about the respective role, about the two roles of the ECB, it's a bit more complicated. So. The ECB is responsible for the single monetary policy, but actually in macroprudential policy, it's mainly a responsibility at the national level. And even at the national level, it's not always the central bank, but it's very different across all the countries. In quite a few countries, the Ministry of Finance is directly involved in the macroprudential policies. But in any case, we do not have a European macroprudential policy. What we do have is the famous top-up. So the ECB could say, well, the the macroprudential authorities are not doing enough. So the ECB has to top up what is done at national level. But actually, so far, this has never happened. In general, I would say there is the idea that monetary policy is responsible for price stability, and the macroprudential authorities are responsible for financial stability. But there are, of course, interactions, and there are different types of interactions. So first of all, I mean, there are situations where monetary policy itself deals with financial stability issues. And this is in particular the case when there are financial market disturbances, as we've seen it during the pandemic, as we've seen in the UK in the context of this famous LDI episode. And these are episodes where then the central bank can come in with particular measures that are aimed at market stabilization. And of course, the goal is to not interfere with monetary policy at the same time. And I actually think the Bank of England example is a good one, because there we saw what the Bank of England did. And you remember there was this kind of what was it called, the mini budget, or in the fall of 2022, and then the Bank of England they moved in, they bought UK government bonds over a short period of time, but then they resold these bonds relatively quickly, implying that this did not have any effect on the monetary policy stance. So that is a good example where the central bank did react, but it did not interfere. Apart from that, this has become more relevant over time, and we've clarified that also in our monetary policy strategy review, which we conducted in 2021, is that we are well aware that our policies have side effects. And one of the important side effects is on financial stability. And that was actually a pretty big topic also in the low interest rate period, where many people were arguing that the low interest rates are going to lead to financial bubbles, to excessive risk-taking, and so on. And so we are actually regularly assessing the financial stability consequences of our actions to make sure that if we have the choice between different instruments, and the two instruments are equally effective, but one of them has bigger consequences on financial stability, we would always choose the one that has less consequence on financial stability. So that's a bit our thinking on that, but it's a complicated and very important topic.
So let's say take one small step away from the more technical topics, and let's talk a bit about communication, because many of the questions that we gathered were about communication and its role. Let me just say that you are active on LinkedIn. You liked our post. Thank you very much for that. And so I'm just wondering if the communication policy that we're seeing at the ECB, both at an institutional level, but also personal level, but also at the Fed and other central banks, is part of the duty of transparency that democratic institutions have, or do you see it as an integral part of forward guidance and expectation setting?
Okay, so forward guidance is a monetary policy tool that would only be, used directly by the governing council. So when we have a monetary policy meeting, and we have that, by and large every 6 weeks, we can, send signals about what we plan to do in the future, and that would be forward guidance. That would never happen, So for example, when I give an interview, I could not give forward guidance because I'm speaking as an individual governing council member, but the forward guidance, the official forward guidance, has to come from the governing council. And of course, the same is true for all social media activities. And as you rightly said, I like to be active there, But the main reason is that, our traditional communication is communication to experts. So we talk a lot to financial market participants, to financial journalists who then write in financial newspapers in a language that normal people don't understand. And we know, and there's a lot of research on that trust also requires understanding. So, and this is why most central banks have moved much more into communicating also with the broader public. And this is, and social media is part of that. Of course, the way I do it is still, pretty technical. But we also try, I try to go to events with young people. I tried, some experimental formats, YouTube and so on, because I think we need to reach different audiences. And
Right. So let's also, since we're in Italy, I think it's normal to talk a bit about that as well. Do you think that there are still, let's say, major risks in terms of the level of debt that we have? I think for most students in the room, we study this in many courses. We were recently given stable outlook by rating agencies. Do you see risks to financial stability in the level of debt that we have, and is it sustainable?
Well, so the debt to GDP ratio in Italy, and I've shown the graph, it remains relatively high. I'm very happy that we now have an agreement on the new fiscal framework. And, from the standpoint of a central banker, it's very important to have such frameworks because that also protects our own independence. I guess it's a consensus that the public debt ratios of Italy are relatively high, and it would be desirable to bring them down a bit. But as I said, the one thing we learned in the years before the pandemic is that fiscal consolidation alone will not do the job if the economy doesn't grow. And I think this is really what we should focus on. Not just, a bit of consolidation is probably needed as well, but we put too little emphasis on the growth part. And this is actually, I would say this is at the moment, and I didn't respond to that, but of course growth, and I'm actually thinking about long-term growth, I would say is the big challenge of the euro area, and that was also what my speech was about last week. That we need to solve, because with low growth we get many problems, and one of them is risks to fiscal sustainability.
We received some questions again on the part of the students, and I would like to now, let's say, ask you to be a professor. We have some questions on the targeted long-term refinancing operations. And the questions were more on a, let's say, high level. Why do we need this kind of long-term liquidity facilities, and why aren't the short-term ones enough?
Yes, so the targeted longer-term refinancing operations are special not only due to the fact that they are longer term, but also that they were targeted. And this was actually quite important. So, first of all, the longer term, of course, gives some certainty to the banks that they can rely on this funding over a certain period of time. It also, by the way, has regulatory advantages because the funding maturity structure matters for the liquidity regulation. But then there was a specific feature, and that was quite important, especially in the pandemic, that the rate that banks had to pay for the lending was linked to their own lending to the economy. And so that was really a tool that had the purpose to foster bank lending to the economy in a situation, and I mean, you saw the dramatic collapse in activity at the beginning of the pandemic, where it seemed to be crucial that banks would not stop lending, and they actually didn't, which was very good. Of course, it was not just the ECB programs which helped, also the governments. I mean, there was this very nice kind of interplay between fiscal and monetary policy during the pandemic, and they complemented each other, and there were all these guarantees that were also coming, and jointly the ECB policies and the fiscal policy helped to keep up lending. And I mean, and so these TLTROs, so targeted longer term operations, I mean, we consider them as an unconventional tool that is used in specific circumstances, but I actually think they have done a very good job. And I mean, one of the features they also have, which is different from the asset purchases, is that they kind of revert automatically. So you have a certain maturity, and then if it's 3 years, after the 3 years, they are repaid, and you know, you do not have to actively reverse them. And we know that with the bond portfolio, of course, it's a bit different, and we have a huge balance sheet, and you know, to reverse that will take a long time, because you have to proceed very gradually.
And I think a final question is a more, let's say, forward-looking one. This is a very important electoral year in Europe and around the world. And obviously, with threats to democracy come threats to central bank independence. And my question is, are you worried about it? Do you think about it?
Well, so I think the ECB is in a rather privileged situation. So we have, I mean, a very strong treaty provision which protects our independence. It's actually an advantage that there's not this one single government that could try to influence us, but there are 20 governments, and they may not always be of the same view. And so it's actually we are pretty much protected. I mean, of course, one challenge is, and you've seen probably that we published our accounts yesterday, that central banks are nowadays facing high losses. And I mean, this is something that we need to properly explain. Because that is something where we have to be very careful, because this could lead to you know, some unhappiness of governments and so on. And it's very important that we explain that this was kind of a necessary consequence of the monetary policy measures that we had to conduct in light of our price stability mandate.
Thank you very much. I think these were the questions on the part of the students. Thank you for your answers. And now I will give the floor back to Diane Carletti for the rest of the session. Thank you very much.
Thank you. Thank you very much, Theodore. Do we have any pressing other questions?
Thank you. I'm Leonardo Segado. Thank you very much for taking my question. I would like to ask you, what do you think the fiscal policy role in creating inflation and then in deflating the economy? Do you agree with Milton Friedman's famous statement about the inflation being only a monetary phenomenon? And the second question is related to this. What do you think if you let's say have read the book Fiscal Theory of the Price Level by Cochrane? What do you think about that? Thank you.
So fiscal policy matters. That's there's no doubt about that. And I mean, we could see that. We could see that very clearly over the past years. And one example that I could give to you is that so we had a pretty common fiscal response in the euro area to the pandemic. So more or less governments were doing the same thing, and then at European level there were additional fiscal measures. The same was not true in response to the energy price shock. And there you actually saw that the responses were very different across different countries. So there were some countries that actually tried to control inflation by various measures, by capping certain prices and so on. And that, of course, immediately had an impact on inflation. It had a negative impact on inflation at that point in time. And then once the measures are running out, it has the opposite effect on inflation. And so you could see that inflation developments in the euro area were very heterogeneous, especially after the energy price shock. And one of the reasons was fiscal policy. I mean, of course, the other point, and it's related to what you mentioned about Friedman. So if you look at the role of money for inflation, and you look at our experience in the euro area, it becomes clear that it cannot be just money. Because, you know, we had this period after the euro area sovereign debt crisis where a lot of money was being created. But nevertheless, we did not get high inflation. Actually, the central bank was very worried about inflation remaining too low in spite of all this money creation. And the reason is that the balance sheets of different agents in the economy were very weak. Most agents were trying to repair the balance sheet, so the banks were not willing to lend. The companies were reluctant to borrow. The governments, I mean, there was all this, what some people call austerity, so no willingness to spend money on the side of governments in spite of super low interest rates. And that was the reason why inflation in the end did not come. If you then compare this with the pandemic, it was entirely different. And there we also had an entirely different fiscal response. So that was a time, so we had again huge money growth. We had a very expansionary fiscal policy. We had comparably healthy balance sheet, fortunately, which also then protected the financial stability. And that was then a time when inflation came back, I mean, for various reasons. But there you can see that, you know, it's not money alone, but the circumstances matter a lot. And okay, so maybe I stop here. So I skip your second question. That takes me a long time.
Okay, we have exhausted the time, but I see still some hands up. So very briefly, maybe let's use some minutes. Let's just take the two questions together, maybe, and then we reply.
Hi, thank you for the speech. You were showing that the spreads of euro area peripheral countries are now very low. But, you know, as Professor Favero was saying, there might be, you know, some risks looming. And we do have the TPI, and it's very good to have a tool that you might not be, that you don't have to use. But if anything happens, how ready do you think the ECB is to actually use the tool?
Second one as well, and then we give the floor to Isabel for the last reply.
Question is regarding the last mile. How does the ECB balance finally achieving its target goal of inflation without disrupting the progress that has been achieved in the past several months?
The progress on inflation?
On inflation and on overall price stability.
Okay. So, well, on the TPI, it's a program that we have in our toolkit. The program is attached to certain conditions. And if the program is needed, the program is going to be used if the conditions are fulfilled. I hope we never have to use it. But of course, if we have a tool, similar to the OMT, we have a tool, and of course, it doesn't make sense to have a tool and not be willing to use it. Yeah, sure. So on the second question, I'm not entirely sure that I fully understood what you wanted to say. Of course, it's a balancing act. It's a balancing act because on the one hand, we have this nice disinflationary trend. We see the economy seems to be picking up a bit. Of course, we do not want to unnecessarily depress the economy, but of course, our main mandate is price stability, so we have to look very carefully at the different risks that we see. And the way I always put it is that we have to look at our inflation projections, of course, and then at all the data that is coming in order to see whether we are confident enough that inflation is going to settle at our target over the medium term. Of course, we do not necessarily need to see that inflation is already at 2% because we have a medium-term objective. But it's a difficult balancing act, and we are trying to do our best by looking at all the data. And you can be assured we're not imposing unnecessary pain on anyone, but we have to fulfill our mandate, and that mandate is, of course, price stability.
Okay, I promised that was the last question, but Donato has asked for the last microphone, so I'm afraid that we have to. Do we have a microphone? Yeah, here, Donato, to you.
Thank you. Isabel, warmly thanks for your speech. Unfortunately, tomorrow it's a sad anniversary, February 24. We discovered that in monetary policy there is normal times, unconventional times, and dramatic times, particularly for your colleague in the Ukraine Central Bank. So just your perspective of these 2 years in terms of monetary policy and, unfortunately, warfare with a war near our borders. So please choose which is your perspective in terms of relationship with Ukraine Central Bank. You mentioned the aggression at the start of your speeches. Just to recall to all of you that it's a sad anniversary that is coming tomorrow. Thank you.
Yeah. No,
whatever is your reaction.
No. Thank you. Thank you very much for bringing this up. Not so long ago, we all thought that it was unthinkable to have such a devastating, terrible war in Europe. And of course, this has changed many things, especially, of course, on the political side. We have, just apart from monetary policy, we have been in contact with the Ukrainian Central Bank, and all the Ukrainian institutions are going to need a lot of support in rebuilding their country. And they also know that there are many economists who are already now thinking about the rebuilding of the Ukrainian economy, and the central bank is going to play an important role there. We also have specific programs for Ukrainian students who actually spend some time at the ECB. These are all these are little things, but I think they do matter. And I've had regular talks to some of those students, and it's quite depressing to talk to them and to hear what they've gone through. Apart from that, we are, of course, in a very different geopolitical situation, and apart from all the human consequences that this also has economic consequences, as we've seen. So for Europe, especially the energy price shock was dramatic. But of course, this is a much broader issue, because we've seen that more generally the world is becoming more fragmented, and this makes many things more difficult. Also, like what I mentioned before, the big transitions, especially the green transition, this becomes much more difficult, because we know that we can no longer rely on all the supply chains that we used to take for granted. And we know that for the green transition, we rely on certain commodities, on rare earth, certain metals, and so on, which may be available only in countries that we may no longer consider to be fully reliable partners. And so this has severe economic consequences, and therefore it also has consequences for monetary policy directly. And we will need to deal with that, and that's very difficult, because again, many of those factors are more coming from the supply side, and it was rightly said. I mean, it's much harder for monetary policy to deal with that. No, but it's a very sad day tomorrow. But actually, every day in the last 2 years has been very sad. If we think about our Ukrainian friends who've been suffering from this war, I mean, it's deeply depressing, and we should not forget them.
Actually, if we want to end on a more positive note, starting with this very last question, I mean, we know that the European Council has started the formal process for the EU accession of Ukraine last December. And actually, within the YEP, we are finalizing now a report with the Goethe University and the CPR and several Ukrainian people, actually. And one of the main objective that we are highlighting there is really that one day Ukraine will not only join the European Union, but also the Euro area. So they're very keen in taking this EU accession process as a real serious attempt to actually become European in no respect. So let's hope that the war will end soon first, and then that we can see better days for Ukraine. With that, let me thank again Isabel for having been with us today. This was a very a fantastic event and a very good occasion to have you with us. Let me give the last thanks before we close. Silvia Tesauro and Elena Surani have made this event possible. A very last thanks, personal note, not least, to Andrea Sironi, the President of the University, for being here with us, Francesco Billari, Director, and Riccardo Taranto, the CEO. Thank you for being with us today. Let's conclude, and thank you again.